Hey everybody, just doing a quick mic check, make sure you can hear me. So we'll be starting here in just a second. If I can get somebody on the Zoom chat to give me a quick comment that lets me know that you can hear me fine, I would appreciate it. Beautiful, thanks Rosie. All right, so we're gonna go ahead and get started. So welcome to my webinar on how to understand and manage your credit profile. So I will be broadcasting this live on Zoom as well as live on Facebook. So if you are on Zoom, you can post any of your questions in the Zoom chat. If you're on Facebook, it'll be delayed by a minute, but you can post any questions on Facebook as well, and I'll reply to those there. I've got a lot to cover in the next hour, and so I'm going to go ahead and dive right in. And again, I want to make this as interactive as I can, so please post your comments and I'll address them as we go. So here we go. First and foremost, credit system overview. First of all, the credit model that most mortgage lenders use is called the FICO system, and it's created by the Fair Isaac and Company. So that's why you hear that term FICO. But the truth is there's actually 3 different scoring models that are used. So the FICO is one of them. You've got the plus score and you've got the Vantage score. And I really don't want you to concern yourself with what the 3 different systems are as much as I need you to understand this is the reason why you get a different credit score when you go to Credit Karma versus when you go to myfico.com versus when you talk to me and I am giving you your credit score. And there's a few other variations that cause your credit score to be different, but very simply, there are different scoring models. And as you can see, they all have a different range. And so when you talk to somebody about my credit scores blankety blank, be careful about where you're getting that information from, because that isn't necessarily accurate for what that particular entity is using it for. It's accurate from where the information came from, but you got to apply it with a grain of salt. So don't call your credit card company and say, hey, John King said my credit score is blankety blank, because we all use a different formula, and you need to be aware of that fact as you're looking at credit scores. Again, for you guys that are just joining in, if you have questions, post them into comments. If you are on Facebook, post them into comments as well. So Judy, you asked about FICO scores going up to 850. So the FICO scale does go up to 850. So what you notice right here, and let me turn on my handy dandy pointer. Woohoo, here we go. And pointer turned on. All right, so it talks about right here that instead of running from 300 to 850 like the FICO system, the plus score runs on a 330 to 830 scale. So the scales are all different. And so when it's kind of like if you're driving down the freeway and you accidentally hit the button to change from miles per hour to kilometers per hour. Well, it sounds like if you looked at the number, like you totally doubled your speed. But the truth is you're moving at the exact same speed because it's using a different scale, and each scale is going to give you a different answer. So a number on a credit report is not unilateral. And that's really the key that I want to point out here. All right, again, if you have questions, post them into comments on Zoom or comments on Facebook. So the FICO system is what I'm going to talk the most about because it's what the mortgage companies use and it's what I thoroughly understand. The modeling is different for each scoring system. What they look at, what they like, and what they want to see in your credit is going to be different depending upon what credit model you're using. But again, here we're running from 350 to 850. The issue is that the information is going to vary on how it's evaluated depending on who's using it. So if it is a credit card company, they're going to care more about how well you've paid your credit cards in the past. If it's a mortgage company, they're going to care more about how well you've paid your mortgage in the past. So this model has different weights that it places on different things. On top of that, there are 3 credit repositories. Those 3 credit repositories are what you're used to hearing: Equifax, Experian, and TransUnion. Those 3 repositories aggregate the information, but then the scoring model is overlaid on top of that. And so when you get a credit score, you can't say, John, my Equifax credit score is blankety blank. Equifax doesn't give you a credit score. Equifax houses the data. You're getting a FICO credit score or you're getting a Vantage credit score, and then there's different versions of each credit scoring model. Again, super confusing. My goal is to confuse you even more. Hopefully I've accomplished that goal. No, totally kidding. But I just want to give you kind of a big overview of how the credit models work, and we'll dive in deeper. The first thing I want to give you is a breakdown of the average and the median credit scores. So the average credit score right now in the United States is 695. The median credit score is 704. That means half the median is half the people are above and half the people are below. Average takes into weight if you have a bunch more people at the lower end that are further at the low end. And so when you look at credit and compare yourself to these numbers, it really fits in pretty well to say, hey, if I've got an over 700 credit score, I'm above average. But a lot of people say, well, gosh, if I'm in the sixes, I'm pretty good. Yeah, you're pretty good, but it's not above average. It's not outstanding by any means. And especially as we deal with credit crunches like we're dealing with right now, it becomes even more important because banks are limiting who they're loaning money to based upon your credit score. It is the old adage that they only want to give money to the people who have money. And unfortunately, it's the truth. Maybe not on have money, but have good credit, because they don't want to trust you to repay their money unless you've proven trustworthy to other people. We're going to talk in a couple minutes about how to rebuild bad credit. So if you're in a situation where you don't have great credit, don't worry, I'll cover that too. All right, so now let's look at average FICO score by age. As you notice, the numbers go up as you get older. So if you're over 55 and you have an under 730 credit score, you are below average. But you can see that in general, we all are pretty dumb with credit when you turn 18 years old. It's the normal thing. What's interesting is that credit card companies know that and they play on it, because what they are doing is they're essentially giving credit to an 18-year-old and saying, hey, go ahead. You don't have a job. You don't have any credit history, but they'll happily give you a credit card. Why is that? Because first and foremost, they know that a lot of the times mom and dad are going to bail you out. You're going to get in credit card debt. You're not going to be able to make the payment, and mom and dad are going to bail you out. Also, half the people that are 18 years old, or more than half, are going to pay their credit perfectly fine, and they're going to remember the company that gave them credit first. So it's really an opportunity for the credit card company to market to new potential clients. That's why at 18 years old, you can get a credit card really, really easy, even though you have no credit. But at 45 years old, if you have no credit, that makes you abnormal. And you'll hear me talk about normal a lot during this presentation, because that really is what the credit scoring system is looking for. It's looking for you to be normal. A normal person has 2.3 children, 1.2 animals, and a white picket fence. And if you vary from that in any way, shape, or form, you're no longer statistically normal. I know I'm being a little bit absurd there, but it's the truth. If the statistics say that the average person at your age has 3 credit cards with this much in balance, has 1 car loan and 1 mortgage, and you aren't normal, that means you have too much or too little off of that statistical norm. That lowers your credit score. It's a theme I'm going to talk about a lot tonight, which is how you fix credit has nothing to do with extremes. Many people go to an extreme and they say, well, gosh, John, if paying down some of my debt is good, then paying down all of my debt is good. If opening up 1 card is good, opening up 10 cards is better. It's not about extremes. It's about being normal. And I know for a lot of us, that's hard. I know for me, it's hard to be normal. But the truth is, you have to try and find a way to meet that model. And if you keep that in mind, don't go to any extremes when it comes to building your credit score. So what's the formula for good credit? Here's the problem. It's a secret. They don't tell you, because they don't want you to know that, hey, it's 2.3 children and 1.2 dogs, and so you're going to manufacture an extra third of a child in order to meet normal. I don't know how that works, but that's not what they want. They don't want you to manipulate your life to have good credit. They want you to live your life, and your life then tells the banks whether you are a good credit risk or not. So I talked about the fact that there are many different filters. So I want to talk more about, if we don't know the formula, how do we know what helps? And it's experience and anecdotal evidence. And I'll actually add to that one more thing, and it is what I call my credit magic system. It is basically a simulator that once I pull somebody's credit, I can run a simulator for the first 30 days after I pulled their credit. And that simulator lets me manipulate anything I want. I can add new credit cards. I can pay off accounts. I can delete bad credit in the history. I can play with time to say, what happens if we pay these accounts down and wait 6 months? wait 9 months, wait 12 months, because time is a big piece of the equation. And this is something that I need you to pay attention to as we look forward in this process, is time has a huge impact on credit. And I'll get to that as we talk a little further. Let's talk specifically about what things go into your credit score. I'm going to remind everybody that if you're following me on Facebook right now, go ahead and post any questions you have in comments. If you're on Zoom, post any questions that you have in the Zoom chat. Click on the chat button and pop it up. And by the way, if you're on Zoom, hop over to John King's Facebook page and share this, because I want all your friends and family to get all this great information. So please help me promote this. You'll find it under my personal page, John King. The picture on there looks just like me, and I appreciate you sharing it. All right, so what does it consist of? Payment history is number one. How well you've paid your bills in the past is the best indicator of how well you're going to pay your bills in the future. That is the number one thing, is paying your bills on time. The problem is, once you get behind on your payment history, you can't fix that overnight unless you try and dispute information and say that it's inaccurate. And I'll talk about that in a few minutes. The truth is, payment history is payment history. And payment history does not care that you paid extra. Payment history simply looks at, did you pay on time? And on time is defined as not being 30 days late. So you can technically have a bill that is due on April 1st. And as long as you paid it by today, and that means they processed the payment by today, you're on the 30th day, you're not beyond 30 days late. Be careful on the 31-day months, because technically on the 31st of the month, you are 30 days late. That counts as a late payment on your credit report. But if you're habitually slow paying, where you might pay 10 or 15 days late, yeah, you're going to have a late fee, but it's not going to impact your credit until you hit the 30-day, after the 30-day late. So it's super, super important when you think about payment history. Do everything you can to keep a payment from becoming 30 days late. Amounts owed is the second biggest category. This one's my favorite because it's the easiest one to fix. All it takes is money. That's easier said than done, right? But it's the truth. Amounts owed has to do with how much you owe compared to your credit limit, and I'll dive into that a little bit deeper. The other three sections: length of credit history, how long you've had your credit. I'll talk about that a little bit further in a couple of minutes. New credit, and then types of credit use. So let's dive in deeper on each one of these in a minute. But first, I want to talk about what does not go into a credit score. These things that you're seeing on the screen, I am not going to bore you with reading all of them, but these things are a lot of misinformation that's out there, that people think this goes into your credit score. Now, some of these are pretty obvious. The first one should be pretty obvious, that we don't put any of those things into your credit score. But your salary has nothing to do with your credit. Your salary is very simply the amount of money that you earn, that we look at from a debt to income ratio, your earnings versus your outgo. But that has nothing to do with your credits. The ratio that matters on your credit is your balance compared to the credit limit. So your salary, occupation, none of that has anything to do with your credit score. All of these things here are super, super important to understand. They do not impact your credit score whatsoever. All right, so let's keep going into why the scores are different. We're going to get a different credit score. I talked about this a little bit earlier, but we're going to get a different credit score for a few reasons. First of all, because there's 9 different platforms or versions of the FICO scoring system. And the crazy thing is that the mortgage industry uses version number 4. And version number 4 came out in 2006. Fannie Mae, Freddie Mac, FHA, and VA, they said, yep, we like that version. We're comfortable with it. We're happy with it. We're going to stick with version number 4. There has been 5 more versions since then, including a version that ignores medical collections. So you might hear that, hey, your credit score doesn't care about medical collections anymore. That may be true for FICO 9, but it is not true for FICO 4, and the mortgage industry has yet to approve any FICO model after FICO 4. So that's important to understand, that you've got a different version of the algorithm, a different version of the scoring system that's used. On top of that, each type of industry uses a different version as well, because a mortgage company is going to care about things different than a car loan company or a department store is going to care about. All right, Judy, you asked me, creditors doing inquiry cost credit, what and how long? I will cover that for sure. I'm going to postpone that because I've got a great slide about inquiries, and I will cover that as we go forward. Again, guys, feel free to post any comments that you have. If you're on Facebook, I'm monitoring those comments. If you're on Zoom, I'm monitoring those comments, and I'll address them as they come up. If they are information I'm going to cover in the future, like Judy's question just was, I'll address it once I get there. So let's talk about the factors that go into the credit scoring system. We talked about payment history. I went already pretty deep into this, but the thing I really want to cover is this example right here. A single late payment is highly damaging to someone who has perfect or great credit. Because the better your credit, now you got to be careful here because it depends on what type of a late payment it was. If you have stellar credit and you have one credit card late payment, that's going to drop your credit some, but a couple of months later, it's going to bounce right back up because the system's going to recognize that wasn't a sign of a whole bunch of bad things. It was one bad thing that happened to a good person. Now, by the way, I'm going to use that example of good person, bad person. If you have bad credit, I'm not calling you a bad person, but it's the easiest way for me to use an analogy of what the credit system is looking at, a good risk versus a poor risk. If you have great credit and you have one late payment, the question is this the beginning of a big problem? Or is this a one-time thing? The better your credit, the quicker it's going to rebound. The faster that drop is going to come back up and be a whole lot better, close to what it was originally. But in part, it depends on what type of late payment it was. The worst thing to pay late is a mortgage. So do not pay your mortgage late at all because that's going to have the biggest impact to your credit. But if you have lower credit scores, your credit's already damaged. You're already in bad shape. One more late payment is kind of the system saying, okay, well, here's another one. We kind of expected it. And so it doesn't harm your credit as much. There isn't as big of a drop to the credit score, but it still extends the deep hole that you're in that you've got to build your way out of in order to get your credit back up. The other thing I'll tell you when it comes to improving credit is I talk to people about the analogy of you being hey, this person can't pay their bills right now. And if you're in that situation, you have really bad credit scores, you're behind on your credit right now. The good news is it's pretty easy to get to the second stage. That second stage is, hey, I used to not pay my bills on time, but now I've caught up and I've gotten myself in good shape and I'm not that person anymore. If you start paying your bills on time, typically just for a year, you can significantly increase your credit score and usually get it into the mid 600s. You can have a huge impact. You could be at a 450 right now. And if you paid all your bills on time for a year, now you have to have bills. I'm going to talk in a couple minutes about lack of credit, but if you pay all your bills on time for a year, that 450 can become 650. The problem is you end up then in credit purgatory. Because the third stage says, I'm paying my bills on time now, and I've never had late payments in the past. Well, that means that those history of late payments have to disappear. And the only way for that to disappear is time. And so if you have that going on where you've had late payments, you've recovered, and now you're in the mid 600s, you're going to be stuck in the mid 600s until that old stuff starts disappearing. That's the credit purgatory. It's unfortunate, it's the reality, but the good news is you can still qualify to buy a home, you can qualify to buy a car, you can get a credit card, you're just not going to get the top tier terms, and it's going to take between 5 and 7 years of good payment history before the bad stuff truly disappears. So the other thing I want to talk about is I just kind of talked about it, length of time since delinquency has been reported. After 2 years, it starts helping even more. But ideally, again, you're still in that kind of credit purgatory where, hey, I used to be late, but now I'm not late anymore. But you're stuck in that middle phase. At least you're not in the phase that says, hey, I'm not able to pay my bills right now. Here is my biggest caution to anybody that's in that middle phase. One late payment takes you right back down because the system's looking at patterns. And it says, okay, he couldn't pay his bills for the last 2 years, but he's been back on time for a year. Well, then we think he's on a better foot. But one late payment says, uh-oh, the last year was the anomaly, and now we're going back into the same pattern again. Even if it's been 5 years of good payment history, if you just have a couple of late payments, the system still has a memory, and it says, uh-oh, here we go again. So you got to be super, super careful if you have challenged credit, and that's the challenge that we got to deal with. Public records, I put a big red circle through this because the credit scoring models have now removed public records from the scoring model. And it's because there was an issue with the Fair Credit Reporting Act. The Fair Credit Reporting Act says you can't put something on a credit report unless you know it belongs to that person. And the credit system could not be sure that public records belong to you because public records do not have your social security number on there. So they couldn't be 100% sure they belong to you. That's really good news if you have any public records, because it came off your credit report in the middle of last year. So it's been almost a year. It was June of 2019 that happened. So your credit got immediately a lot better. Now, we still look for that through a different report. So it doesn't mean you can buy a home and have no problem if you have a public record, but it doesn't impact your credit score. And that's super, super important. All right, moving on. Again, if you have questions, feel free to post those questions on Zoom chat if you're on Zoom, on Facebook chat if you're on Facebook. I'm watching it there as well. Here's my favorite thing I talked about, which is the easiest way to improve credit is to decrease your utilization. The ideal number is to have less than 30% of your credit limit charged up. And here's the whammy. Home equity lines of credit are considered revolving accounts. And so you have a negative impact to your credit when you go get a home equity line of credit or a second mortgage that's got a line of credit you can borrow from. It significantly lowers your credit score because you just got a new credit card that you charged up 100% of the credit limit. So it is hurting you. And this evaluation is per card. So if you have 5 credit cards and 4 of them are paid off, but the one that gives you miles and the one that gives you rebates and the one that has the lowest interest rate, well, you charge that one up to the max. The problem is that one credit card is harming your credit score because it does not aggregate and say, well, yeah, you owe $5,000 on this $5,000 credit limit, but you got 4 other cards that also have $5,000 credit limits you're not using. People assume that we add up all $25,000 and say, well, yeah, you only owe $5,000 on $25,000 of available credit. That's a good thing. It isn't, because we look per card, and that one card being highly utilized is hurting your credit. The same holds true for people who charge up and pay down every single month. It is going to hurt your credit because the credit reporting system picks one day a month to update your credit card balance. And it's often a day when your balance is up high. And so if you're trying to buy a house, you're trying to get a credit card, you're trying to maximize your credit score, keep those balances as low as possible for the month leading up to when you expect to pull your credit. All right, our next question, does it hurt the credit if an owner of a credit card lowers the limits? Yes, it hurts the credit. It absolutely hurts the credit. Many people, you actually jumped into one of my myths, Judy, but I'll cover it right now anyway. So I'm gonna cover some myths later. So one of the myths is that, hey, if I lower my credit limit, that's good because the banking system knows that I don't have the ability to run out and charge up a bunch of debt. It's the opposite. The banking system wants to know that you have the ability to run up debt, but you have the self-control to not charge up debt. So I use an analogy with all of my clients that have challenges with utilization. And it's basically, if you took a 5-year-old to the dollar store with $5 bills in their pocket. So that $5 bills in their pocket is their credit limit on the credit card. We all know that a 5-year-old going to the dollar store is going to want to buy 5 things when they have $5 in their pocket, and they're not going to understand that whole thing tax, right? But the truth is they're going to want to buy 5 things because they have no self-control. And so if you have no self-control as a 5-year-old and you're going out and charging up your credit, you're buying all 5 things, then we're worried as a creditor that every opportunity you have that you get a dollar to spend, you're going to run out and spend it as quickly as you can. The opposite, though, what a lot of people would say is, okay, John, that's fine, that's fine, that's fine. Then as a 5-year-old using that example, just stop taking me to the dollar store. That's like closing your credit cards. But closing your credit cards doesn't help prove that you have self-control. It proves you're able to do avoidance, but it doesn't prove you have self-control. So then you say, fine, fine, fine. Take me to the dollar store, but don't let me go inside. That's kind of like having a credit card. You know, you drove to the dollar store. That's like having the credit card, but you never charge on it. If you never walk inside the dollar store, you're not really tempted because you never saw anything. So you have to prove that you're using credit in order to have credit. And so you have to charge up on there. Then you say, fine, fine, fine. Then take me to the dollar store and only let me bring $1. Well, that just still means that the only way you can practice self-control is because you're forced to practice self-control because you lowered your ability to spend. That's exactly what happens when people lower their credit limit. So the true testament of self-control and creditworthiness is if you can go to the dollar store with $5 or even $10 or even $20 in your pocket and you leave walking out with two things. That proves that you can spend money, but you're choosing not to. That's the epitome of self-control. Judy, the question about if you lower your limits, how long does it take to recover? The cool thing about utilization is it's instant. Instant once it updates on the credit report, which can take up to a month. But as soon as the balance updates, there's no history, there's no memory of what your utilization percentage used to be. That is super, super important because if you lowered your credit limit, but you still have reasonably good credit, quickly call up the credit card company and say, oops, I made a mistake. Can you give me a higher credit limit? You want to increase your credit limits, not decrease your credit limits in order to improve your credit score. The other thing we look at is amounts owed on installment loans. So when we talk about types of credit, this is where we're talking about what type of loan that you have. Certain types of creditors are known as a creditor of last resort. Finance companies are that way. So if you go to a furniture store and you finance through Wells Fargo Financial, that's actually considered to be a high risk lender of last resort. And therefore it lowers your credit score simply because you have a loan with that type of lender. So that makes a huge difference on your credit score, as well as the number of accounts on your credit report can be a challenge, can be a bad thing, but you got to be careful because age of accounts is super, super important. So if you're going to close an account, close the ones that you've had most recently opened. You want to keep the older accounts. It's kind of like dating. If you look at a guy who's 45 years old and has never had a date in his entire life, you're going to wonder what's wrong with that guy. It's the same thing with a credit card company. They say, wait a second, you're 45 years old and you have one credit card that you've had open for 1 year. What is wrong with you? Why can't you maintain a relationship with a creditor? It's the same concept that you have to understand. The credit system does not want to be the first person you try yourself out on. And so you have to have long-term credit, and you have to make sure that you're maintaining relationships with those creditors that you've had for the longest amount of time. So do not close credit cards from creditors that you've had for a long time. Make sure you keep those open. Even if there's a small annual fee, pay it. It is worth the improvement to maintaining your credit score. Length of credit history is another piece. I think I actually went into that a little bit on the previous slide. That's a portion of it. But here's the piece I didn't talk about yet. You can actually hurt your or lose your credit score by not having any activity. So those all cash people who think, well, gosh, I'm a good credit risk because I pay everything in cash. That's a bad thing because you have no history. Even if you've always paid everything perfect and you have amazing credit, if you close all of your credit cards, pay off your mortgage, pay off your car, and you have zero debt, 6 months later, you also have zero credit score. The good news is you can have a credit score rebuilt immediately by going out and opening up one credit card and bam, you have great credit again. But that doesn't help you if you find the perfect house you want to buy and you got to go buy it now and you realize that you've been living off the credit radar for the last year, you might have no credit scores. Another quick trick is to add yourself as an authorized user to somebody else's account. That's been a pretty old trick that the credit systems are trying to get rid of. Some of the newer models of credit scoring ignore authorized user accounts. How an authorized user account works is you go to mom and dad and say, hey dad, hey mom, my credit's not so hot, but could I be added as an authorized user on your blankety blank credit card? And mom and dad say, yeah, sure. So they call up the credit card company and the credit card company says, sure, mom and dad, we trust you. We'll give a card to your kid because it's mom and dad's account. But the credit system grabs all of mom and dad's credit history. Hopefully it's a good credit card. And so if you've got a 21-year-old that goes on to mom and dad's credit card that mom and dad have had opened for the last 25 years, you can literally have a 21-year-old that has a 25-year credit history. you're instantaneously assuming the credit history of that credit card depending upon the credit scoring model. I'll tell you that the credit systems are trying to eliminate that because that really is a loophole. It is not a true reflection of your credit worthiness. And so they're trying to get rid of it, but it still does exist as a loophole. Shh, don't tell anybody I told you. All right, good thing this isn't being broadcast on Facebook or anything. All right, so amount of new credit. New credit lowers your credit score, but only a little bit. Only 10% of your credit limit has to do with new credit. And so don't avoid getting new credit if otherwise it would help you. And I'll explain in a couple minutes where you need to get new credit in order to rebuild your credit scores. But it's super, super important not to be overly concerned about new credit. And don't open new credit for no good reason. But the fact is, new credit does help your credit, or does hurt your credit score, but it's a minor pain. All right, and again, they're looking at the last 24 months of how many accounts have been opened in the last 24 months compared to your total number of accounts. So if you have 10 credit cards and 8 of those 10 credit cards were opened in the last 2 years, that's really what it's looking at. It's not saying, oh my gosh, they opened a new credit card last year. That's not a big deal. If you have 10 credit cards and 1 of them was open in the last 2 years, no big deal. It's about the percentage of your cards that you opened in the last 2 years. Hopefully that helps. Types of credit use, okay, so I covered this in a prior slide, so I'm gonna go ahead and slip that one for the sake of time. All right, so Judy, we're talking about inquiries. So I have a whole slide on inquiries right here. There are 2 different types of inquiries. You've got a hard inquiry. A hard inquiry means you asked somebody to pull your credit because you were applying to get or take on new debt. You call your credit card company and say, hey, I want to get a new credit card. I want to increase my credit limit. That's a hard inquiry. You call me and you say, hey, John, I want to qualify for a mortgage, which, by the way, if you want to qualify for a mortgage, that's what you do is you call me because that's how I get paid. Aside from that, when you do a hard inquiry, you're telling the credit system, I am interested in taking out new debt. That is a predictor of future credit load, and people who take a whole bunch of inquiries in a short amount of time are indicating they're about to open up a whole bunch of debts. 1 inquiry is normal. 14 inquiries in 7 days is not normal. Inquiries are what I talked about earlier when I said the credit system wants you to be normal, 2.3 children, 1.2 animals, and a white picket fence. It is normal to have your credit pulled periodically. It is not normal to have your credit pulled 14 times in 7 days. So each additional inquiry is exponentially more painful to your credit score, more harmful to your credit score than the prior one, but all depends on time and how quickly you're doing all of those. Somebody who's about to file bankruptcy oftentimes will try anything they can to avoid it by saying, well, if I just go out and get a whole bunch more debt, then I can survive for a longer period of time until I figure out how to handle all of this. That's really what the credit system's looking at. The other thing a lot of people ask about is inquiries for mortgages and inquiries for cars. Because when you are buying a car, specifically, you go to the car dealership and they're going to run your credit with Toyota, they're going to call Wells Fargo, they're going to call Chase, they're going to call everybody and have your credit run 12 times. The system knows you're not trying to buy 12 cars. So it gives you a grace period, it gives you a free pass, and it says, hey, that counts as 1 inquiry. The same holds true for mortgages. If you talk to a mortgage guy that's not me, and you find out, oh my gosh, this guy isn't John King. I heard John King's amazing, and I don't know how I got in contact with this guy that's not John King, but I need to call John King. Y'all understand the subliminal messages right now, right? Okay, we're on the same page. So you call me and you say, John, I want you to help me out because I know you're really good at what you do. And I say, great, I need to pull your credit. No, John, you can't because somebody else pulled my credit. Don't worry, the credit system knows that you're not trying to buy 2 or 3 houses. The credit system knows that you just need to talk to a different lender for any number of different reasons. It's not going to punish you. It's not going to lower your credit score simply because you had 1 or 2 or 3 people pull your credit during a short period of time. That period of time is typically 30 to 60 days, depending upon the scoring model. Soft inquiries are different. Soft inquiries are things you did not apply for. So that is Credit Karma looking at your credit score. That is your credit card company mailing you a pre-screened offer that says, hey, John, do you want to get a credit card? those pre-screen, those soft inquiries should not hurt your credit score. But here's the truth. Anecdotally speaking, I have found over the 19 years that I have been doing this, that if you opt out of receiving those pre-screened credit cards, your credit score goes up. So you can go onto this website, optoutprescreen.com, optoutprescreen.com. And you can opt out for 5 years, or you can opt out permanently. And yes, there's a button to opt back in. What I tell people is, if you're just looking to boost your credit and get an improvement because you're trying to accomplish a goal, opt out only for 5 years, because the 5-year opt-out is automatic once you press the button on the website. You don't have to mail in a signature authorizing form. If you go the permanent method, you have to mail in a form with your signature authorizing them to remove it permanently. So the fastest way to do it is the 5-year opt-out by going out to opt-out pre-screen. If you read the literature, it says that these pre-screened offers will not impact your credit score, but anecdotally, I've seen it increase your credit score. It's kind of like putting Vicks vapor rub on your feet when you got a cough. I have no idea how putting Vicks on my feet makes my cough better, but it seems to work. I also have no idea how opting out of soft inquiries helps improve my credit, but it seems to work. So go ahead and do it, and we'll see what happens. All right. So here's the deal. If you have bad credit, there's only 2 ways to fix it. You need to build better credit, and that comes with time. But it doesn't come with time of just sitting there doing nothing. You have to use credit to build credit. So go get credit and make sure that you are proving you are credit worthy. Think about the example I gave you earlier about the 5-year-old going to the dollar store. Do not hide from the dollar store if you have bad credit. You have to keep going back to the dollar store with as much money in your pocket as you can and prove that I can go in there and I can spend $1 and I can pay it down and I can spend another $1 and I can pay it down. That's what you have to do to build new credit. You can also look at repairing your past credit. But let me be super clear. These are the only 2 ways to improve your credit, is to either build better credit in the future or repair your credit history in the past. How do you repair past credit history? 2 choices. You can pay someone to do it, or you can do it yourself. And I am going to pause for a quick second because I got a frog in my throat. All right, I'm back. So you can pay someone to do it, or you can do it yourself. Here's the reality. You paying somebody to fix your credit, there is nothing they can do for you that you can't do for yourself. It just means you have to do the work. You have to dispute it. You have to call the credit card company and fight them. You can do anything that needs to be done yourself, or you can pay somebody else to do it, but there is no magic pill that they have. Most of those credit repair companies are simply writing letters on your behalf saying, I didn't do it, it's not mine, prove it's mine, or take it off. Well, if you knew it was yours, then the truth is you're lying by saying it wasn't mine. Now, I'm not telling you don't lie. I'm just telling you, why pay somebody else to lie for you if you just can lie for yourself for free? So write a letter to them saying, I didn't do it, it wasn't me, prove that it was me, or take it off my credit report. And they only have a certain amount of time to prove it was you, or it disappears from your credit report. So to be clear, if you're going to pay somebody else to lie for you, or you're going to lie for yourself, it really doesn't matter. It certainly doesn't absolve you of the sin of lying. Now, I'm not telling you it's a sin to lie and say it wasn't yours. That's you to judge whether you want to do that or not. But the truth is, paying somebody else to repair your credit is just throwing away money. And for most people, if you have challenges with your credit, it means you don't have a lot of extra money. So I don't know if that's the best place to spend the money you have by paying somebody else to help improve your credit. As a reminder, if you have questions, please post them onto the Zoom group chat if you're on Zoom. If you're on Facebook, I'm monitoring the Facebook questions as well. Feel free to post them there as well. So here's my secret formula, not so secret anymore. Here's my secret formula to improving your credits. 3 things: pay all your bills on time. Duh, John, we kind of know that. Yeah, but it's super simple. You don't have to pay extra. I said that earlier. Just pay them all on time. And on time is less than 30 days late. Judy, you asked, how many lines of credit do you need? Ideally 3. That's why I say open, if you have negative history, if you have bad credits in the past. And by the way, guys, everything I'm telling you is my best guess. You heard me say earlier, we don't know what the model looks like. So this is 19 years of experience you're getting, and it's anecdotal evidence. So when I say 3, that's a swag, a strategic, wild, blank guess. So the truth is, it is scientific, whatever. The point is that it is three is kind of like juggling. Think about if you're juggling and you have two hands and you have one ball. How hard is it to juggle one ball? Not very hard. So you add one more ball. How hard is it to juggle two balls when you're using two hands? Not very hard. But when you add that third ball makes the world of difference between being able to juggle successfully or just tossing two balls in the air. The same holds true with credit, because having multiple accounts that you're paying on time and have good standing on shows that you can juggle the debt. Because a lot of people say, John, I don't want to owe on a credit card, so I'm afraid I might not pay it on time. I lose the bill. I don't open my mail all the time. Well, guess what? I don't want to loan you $500,000 or $300,000 on a mortgage to see whether you're going to now start opening your mail on time or remember to write the check. So prove it on the credit cards. Open 2 or 3 accounts and make sure that you're juggling those bills. They're due at different times of the month. That's what we're trying to prove, is that you can manage that debt. The second thing is, as you open those new accounts, remember, you're opening new accounts if you have negative credit, and most of the time, you have to get what's called a secured credit card. A secured credit card is you are writing a check to a bank, and they're saying, hey, give me $500, and I will take that $500 and lock it up into a special savings account that you can't touch. And we'll keep that as security, as collateral against a $500 credit card. Now you got a regular credit card. You pay interest, you pay fees on that credit card. You got to mail the check every single month. It is not a prepaid credit card. You have to pay the bill every month. Do not do what one of my clients did, which said, you know what? I didn't want the credit card anymore, so I told him to just keep my $500 and we were square. And he couldn't figure out why it harmed his credit score. He said, they had my $500. I just told them to keep it. That's kind of like calling the bank and saying, I don't want to be a homeowner anymore. Just keep my house. It's not a big deal. That's called foreclosure. You can't tell a creditor, I've changed my mind, go ahead and keep the collateral. Hey, car company, come on in and pick up my car. I've decided I don't like it anymore. That is the fastest way to ruin your credit, and the same holds true on secured credit cards. Don't ever decide, I'm done with this secured credit card. I'm just going to stop paying, and they'll just keep my $500 and we're good. They're going to report you late. It's going to destroy your credit. When you use credit cards, always keep the balance between 10 and 30% of your credit limit. Now, this is where I'm talking to people who have really good credit. You have great credit, and you're trying to figure out, John, how do I maximize my credit score? How do I get the elusive perfect credit? There is no such thing as perfect credit. I'm going to use a medical analogy to say, is there such a thing as a perfect blood pressure or a perfect heartbeat? There is not. It depends on whether you were just exercising. It depends on whether you're stressed out. It depends on whether you're asleep. All of those factors change what your blood pressure and your heart rate are. The same as a lot of factors impact your credit score. It's about being in the range of really good credit. So everything that I've said tonight, take it with an understanding that all credit advice is different based upon your credit situation. Even what I'm telling you right now, as perfect as I am, is not perfect advice for your situation. The only way you're going to get perfect advice for your situation is to let me pull your credit and for me to run my analyzer. But if you have really good credit, if your credit score is over 760, don't stress about how to make it better. That just means you have 2.7 children instead of 2.3. It's no big deal. You're still in the category of amazing credit. 760 or better gets you anything you want from anybody. That is the most important thing I can tell you about credit. When you have great credit, don't try and figure out how to make it perfect, because anything you do to an extreme is going to hurt your credit. Just be normal and be happy that you have good credit. But I'll tell you that ideally you want to keep your credit cards between 10% and 30% of your credit limit, especially when you are building new credit. When you have poor credit and you're rebuilding that poor credit, you need to make sure your balance is never below 10% and never above 30%. That's the key. A lot of people ask me, John, should I pay off collections? You should pay off recent collections that are less than 2 years old. Collections, now I'm not talking about whether you should ignore your debt. You should always pay all collections. But as far as the impact to your credit score, if you pay a collection greater than 2 years old, it actually harms your credit score, because the system looks at it and the system says, well, that used to be them. And I know it's an unpaid collection, but they're not that person anymore. But once you pay it, Now it looks like you couldn't pay it yesterday, but you did pay it today. That's going to drop your credit because it's taking what the system says is, oh yeah, 2 years ago, 5 years ago, they couldn't pay a collection, but they've been good on everything since, and makes it a collection you couldn't have paid yesterday that you finally paid today. It re-ages the account and it will lower your credit score. So be careful if you're trying to improve your credit. Do not go back and pay off old collections, typically paying only the ones that are less than 2 years old. And with my credit simulator, when I pull your credit, I can actually simulate to say, what if this is paid off? And if it's paid off, sometimes even when I guess that it's going to help the credit, I find out that it's not going to help the credit. The other thing that I'll tell you is the other thing you can do to improve your credit if you have collections is to negotiate with the creditor to get them deleted. To delete a collection is a part-time job. You have to pick up the phone and call the creditor and say, hey, Mr. Creditor, I owe you $500 and I'm willing to pay it to you under one condition. No, Mr. King, there's no conditions. You owe us some money, you got to pay it. Well, you know what, Mr. Creditor, I understand that you want my money, and so I'm only going to give you my money under one condition, and that is if you delete this from my credit report. I'm sorry, Mr. King, that's illegal. We can't delete that from your credit report. Okay, no problem, but I'm not paying you unless you do, so how badly do you want my money? Can you guys see where this negotiation is going? It's going to be about who blinks first. It's a game of chicken. Now, here's your strategy. If you get to the end of that call and that person is adamantly saying no, ask for their boss. If they say no, ask for their boss. At a certain point, when everybody says no, hang up and call again tomorrow. And you follow the same process. At some point, somebody in the organization wants your money more than the principle of keeping this account on your credit reports. And once you get them to agree that they will delete it, and don't let them agree, oh, yes, Mr. King, we will show it as paid in full. Don't worry, we'll delete the balance. I don't want the balance deleted. I want the entire reference to it expunged from my credit report. And I want you to put that in writing that once I pay you, this will be deleted in full from my credit report. Only when you put that in writing will I pay you. Do not let them get the money from you before you have it in writing, because otherwise they don't have to honor it. So that's super, super important strategy to help build credit. All right, as a reminder, if you have questions, post it on the Zoom chat. If you're on Facebook, I'm watching the Facebook chat as well. So feel free to post your questions on the Facebook chat also. All right, so is there a quick fix to my credit? Yes, utilization. I've talked about that a lot, but here's the key. If you have high balances compared to your credit limits and you pay them down, I've seen as much as 80 to 120 point increase from decreasing your utilization. And by the way, gang, you can decrease your utilization two ways: paying down the credit balance or having them increase the credit limit. All that matters is the percentage of what you owe compared to the credit limit, and you can decrease that percentage by lowering the balance or by increasing the credit limit. And then also currently delinquent accounts need to be paid up. And if you do that, like if you have, let me make that clear. If you are currently behind on a credit card, and at this moment you have a credit card late payment, once you make that payment and catch it up, it will also significantly improve your credit score. All right, I got about 12 minutes left. I want to go through, I've got a fair number of things I still want to cover. Should I use Credit Boost? Credit Boost is not worth it. Credit Boost adds utility bills and phone bills and rent to your credit report. I have not seen any good results from it. I do not believe that it's worth it, and it does not help with mortgage credit scores. If you need to dispute an account, I'm not going to go too deep into this. The bottom line is, if you dispute an account, it hurts your ability to borrow money on a mortgage. So just don't go disputing accounts before you open up a mortgage. It's a problem for us if you have disputed accounts at the time that we're doing the mortgage. And we need to remove the dispute, and this goes over the process. But the thing I want you to know is that it can take 30 to 45 days to remove a dispute. You can do it by calling the credit bureaus directly, or we can submit a rescore request and do it faster, but we have a cost for that, and we're only going to do that if we're in the process of doing a mortgage for you. So just don't do a dispute on your credit report. We can do a rescore. A rescore is something if you're in the process of buying a home and something is on your credit that we need to fix, we can get that adjusted manually really, really quickly. We might do that because there's erroneous payment history, the balances have changed, maybe some charge-offs or items have been included in bankruptcy, or accounts that show heavy use of available credit, but maybe you've paid those down, so we can update that. or any missing accounts that have on-time payment history we can get added. So I want to go through some fun fact or fiction. So we need everybody to play along here. So I need you to tell me on this first question, does paying cash help repair bad credit? Yes or no? Give me a comment. So plug into comments. Does paying cash, say yes if you think paying cash helps repair bad credit. Say no if you think it doesn't. All right, I got one answer. Two. I got three. All right, the answer is no. You have to prove responsibility to rebuild your credit. So make sure that you are owing money. Paying cash does not help rebuild your credit. Question number two, every inquiry drops your credit score. Fact or fiction? Is that true or not true? Come on, guys, this is the fun game. All right, we got false, we got no, we got false, no, not. Well, it's kind of a trick question. It does, but not very much. So hopefully you got that from our earlier part of the conversation. It does impact you, but it is such a small impact. It's the exponential impact of doing multiple inquiries that is going to hurt your score the most. All right, next one. Having too many credit accounts hurts your rating. Is that true or is that false? Oh, we finally have some debate. We finally have some people that are saying both sides. So oddly, the opposite is true. It's having too few. Common sense says if you have more credit accounts open, then you have the ability to get into deep trouble. But the truth is, the system really isn't worried. If you have 14 credit cards that you've had for 10 years and you've paid them on time, you're good. So those of you who said no, you're right. Having too many credit accounts does not hurt your credit rating. Too few can hurt you and too new can hurt you. All right, next one. This is a fun game. I knew y'all should know this one. I covered it. Authorized user accounts can help build your credit. True or false? I got a yes. What else do I got? I got a true, I got a true, I got a yes. Absolutely in the short term, but sometimes it can backfire. So just be aware that loophole exists. Kids credit, exactly. So the loophole exists, but sometimes it can backfire, especially don't take on a credit card from somebody that doesn't have a good payment history because you're inheriting their entire history. You're also inheriting their utilization. So if mom and dad have a credit card that they charge up every single month pretty high, don't get added to that card because that could hurt your score just as much. All right, next one. Asking for a credit line increase helps your credit score. True or false? Oh, Michelle's got a caveat. Yes, if used right. Absolutely. It decreases your utilization. So asking for a credit line increase is good. Honestly, there's really no negative to it other than the fact that you don't want to have a whole bunch of people doing it at the same time because it is an inquiry on your credit report. All right. So fact or fiction, I should close a credit card account I don't use. Yes, I should. No, I shouldn't. Love it. You guys are great students. No, because it decreases your available credit and increases your utilization. You also want to keep the old cards open to prove you can maintain a relationship. Beautiful. All right, well, this one got goofed up because you have the answer right there. And once you paid off a past due debt, it will drop off your credit report. The answer is no. So if any of you answered no to that, good job, you had the answer right there. Late payments remain on the credit report. The damage is done. The only way to fix a late payment is to A, get them to remove it, or B, time served, time in your history of showing you've paid your bills on time to prove I'm not that person anymore. That's what's super, super important. All right, so I want to cover 4 common credit mistakes. Asking the creditor to lower your credit limit, we've talked about that. Making a late payment is a big deal. Consolidating your accounts. I have so many people that say, John, I want to fix my credit, so I closed all my credit cards and consolidate it into one lump sum account that is a loan instead of a line of credit. Well, that's a good thing if you put it into a loan, as long as you keep those credit cards open. But the biggest mistake is consolidating your accounts and then closing the credit cards. That will ruin your credit score. Do not do that. Do not close old accounts. And don't apply for new credit if you already have plenty. Again, too many accounts isn't necessarily a bad thing, but it's the applications that is an inquiry, and it's the new credit that's skewing the numbers. But again, if you have great credit and somebody says, hey, I'm going to give you 10% off of this bill if you open up a credit card with us, do it. Who cares? Okay. But if you don't have great credit, don't do that. But if you have great credit, don't live your life to have perfect credit. Save 10%, get OPM, other people's money. If they'll let you owe them money and pay it back in a year with no interest, take them up on it, because you can put that money to use in some other way. But don't open it simply for the sake of, oh man, other cards is great, no big deal. Be careful. All right, so tips on raising credit scores and improving your profile: pay your bills on time, get current and stay current, have a long-term strategy with your debt of how to get it paid down. For some people, the best strategy is to pay the snowball effect. So you basically take all of your credit cards. Judy, I'll get to your question in a second. Take all of your credit cards and you add up what the payment is, and you have a total amount of payments. You pay the minimum on everything except the smallest credit card, and you pay that as quickly as you can. Now, once that small credit card is paid off, now you take the money you were paying on that small credit card and add it to the payment, the minimum payment you were making on the next smallest card. And that card quickly gets paid off. Now you take all the extra money you were paying from the first card and the second card, add it to the third card. Dave Ramsey, absolutely. Okay, so guys, the snowball effect works really, really well. It is not a great way to improve your credit score. Improving your credit score has to do with getting the utilization down on everything. So it all depends on your long-term strategy. Are you trying to get out of debt, or are you trying to get the best credit score to qualify for better terms on a loan? Two totally different strategies, two totally different outcomes. If you're trying to improve your credit score, pay all your debt down equally, not equally in dollars, but equally in percentage compared to the credit limit, so that you can get everything under 50% of the credit limit, then everything under 40% of the credit limit, et cetera, until you can get to that 30% number. Don't close accounts, don't open a lot of accounts. Check and monitor your credit history. I didn't put this on there, but it is free annualcreditreport.com. I'm going to put it in the chat. Free annual credit report. Oops. freeannualcreditreport.com. You go anywhere else that sends you a credit report link to say, hey, you can get a credit report right now. You're paying for it in some way, or you're signing up for some service, and it is going to cost you. And so don't go and get a credit report from any of these systems and say, oh, we'll give you a free report. Free annual credit report gives you a credit report once a year. The best strategy is to get one every 4 months, because you get one per year from Equifax, Experian, and TransUnion. It does not give you a score. You will not get a credit score. You're not doing it for scoring purposes. You're doing it for accuracy of information. You'll know if somebody has hacked you and stolen your identity and pulled credit. You'll know if something is showing up late that you know wasn't late. You'll know a lot of things. So you start by, on January 1st, you pull Equifax, and then 4 months later you pull Experian, and then 4 months later you pull TransUnion, and then 4 months later you're back to January 1st and you pull Equifax again. I don't care what order you do them. I don't care what date you do them. That is the best strategy on the same website that I just showed you, freeannualcreditreport.com. And when you go to that site, you order one of the three. 4 months later, you order another one of the three. 4 months later, you order the third one. That is the best way to keep on track of your credit history. All right, so now I want to talk to you about a little bit about kind of mortgage stuff. So let's go into, I'm gonna cover this briefly. We only have a couple minutes. The reality is we're dealing in strange times right now. I don't expect that we're gonna have anywhere near the challenges we've had in 2008 when it comes to mortgages and credit and mortgage payment history, but I wanna address it a little bit. If you're in a situation where you can't pay your mortgage, first of all, go into forbearance. You've heard me on a lot of videos say that's a horrible idea because it hurts your ability to get a loan. Having a mortgage late hurts your ability to get a loan even more. But when it comes down to, if you can't pay your mortgage, sell the house. Don't get yourself in a position where you're losing it. But if you're going to lose it, do a short sale. A short sale typically is better on your credit than a foreclosure. But guys, we shouldn't be in short sale positions right now because most people have significant equity in their home. So that shouldn't be something that we're dealing with. If you do, and you have a bankruptcy, you've got to wait between 2 and 4 years, depending upon the type of loan, or FHA, 1 to 2 years waiting after a bankruptcy. USDA and VA. For a foreclosure and short sale, it's anywhere from 2 to 7 years for foreclosures versus 2 to 4 years for short sales. So it's not as bad of an impact to your credit score. But again, I hope we don't go into those times right now. I think housing prices are going to stay strong. We're going to see a bit of a challenging year this year. I'm not sure if we're going to see housing prices go up, stay the same, or drop just a little bit, but demand is hugely strong. A lot of buyers trying to buy homes. Rates are super, super low. I expect housing prices to continue to go up until around 2025 or 2026 before we start seeing them peak down a little bit. If you wonder if it's a good time to buy or not, I did a video last week on if you're a homeowner and should you buy. Check out that video on my YouTube page, youtube.com/JohnLoanKing. If you guys have any questions about anything else, feel free to hang out. I'll answer questions on here. Otherwise, thank you. Please share this on Facebook, share this on YouTube. I'll be posting it tomorrow. I appreciate all of you. And if you have any questions, I will take those questions now. Judy was asking 2 questions. If you're disputing charge on a credit card, how long does a client wait? A dispute can take 60 to 90 days to resolve. So be careful about the dispute process. You really should contact the creditor directly. They can get it resolved faster, but the dispute can take quite some time. And then you also asked if there are any investor cash out loans. I don't, that's a whole nother problem. Cash out has come under fire. Most banks, because Fannie Mae and Freddie Mac did some fun with words last week and basically made it a huge risk on the bank if somebody pulls cash out and then goes into forbearance. Most companies, including Summit Funding, are no longer doing cash out on investment properties, no longer doing cash out on second homes. So Judy, I don't know of anybody who does cash out on an investment property right now. The issue is about forbearance. So they'll come back, but it's going to come back either once Fannie Mae and Freddie Mac make a better decision about the fact that they are going to buy loans from us that are cash out, that go into forbearance, or once the forbearance crisis is over. But until then, I don't have any investor cash out, and I don't know anybody that does. Are there any other questions from anybody at all? Again, I'm happy to help answer the questions. Otherwise, I'll be here for about another minute, and then I will disappear. So thank you again. Thanks, Rosie. Bye. Appreciate you joining. Please share. And guys, I just want you to know, most importantly, all of the information I gave you is general information. And it's accurate at a big high level, but you have to pay attention to your particular circumstances. It's like medical advice when you go to your friend and say, oh my gosh, you have high blood pressure, so do I. Then take their high blood pressure medication. Oh, wait, no, it will kill you if you take somebody else's medication. Same thing, somebody else did something to improve their credit. Oh, perfect, I'll do the same thing. It might destroy your credit because it's about their credit history, and the advice that we gave on how to improve that person's credit has to do with the ailment, with the history of what their credit was, and you might not have the same ailment. The solution would poorly fit your ailment and could cause more problems for you. All right, guys, no other questions. Appreciate all the thank yous. Have an absolutely amazing night. Remember, I do these every Thursday night, so go to RSVP with John for information on my upcoming events. RSVP with John. Have a great night, and we'll talk to y'all soon. Bye.